Every day, a business receives cash and pays cash. So in this video, we're going to be looking at how we record for these cash transactions. Here's a quick recap on source documents to verify cash receipts and cash payments. Can you sort this out? Now that we have the source documents, the question is, what are we going to do with them? That's the focus of this video, where we'll be looking at recording these cash transactions into two special journals, and they are the Cash Receipts Journal and Cash Payments Journal. The Cash Receipts Journal is for recording all cash receipts. So here is an example of a cash receipts journal. In here we record the dates, the transaction details, and the document ID, which are the reference numbers of source documents used to verify cash receipts. These could be things like receipts, memos, EFT documents, and bank statements. In the bank column, we record the total amount received in the bank. Once we've done that, we need to separately classify the cash receipts depending on the transactions that have occurred. In the case of, say, a painting service business, painting fees would be a very frequent cash receipt transaction. In this case, we create a separate column to record painting fees. For less frequent cash receipt transactions, such as capital contributions and interest received in the bank, we classify them in the sundries column. Lastly, the GST column is used to record any GST received as part of a sale or service fees. Now we're going to look at some examples of cash receipts transactions and how we record them in a cash receipts journal. Big Boss has a personal training business, and we're going to record the transactions that have occurred in April. So on the 1st of April, the business has received $300 plus GST for personal training services. We record this in the cash receipts journal. First, we write the date, followed by the transaction details, which is training fees, and the document ID, which in this case is receipt 30. In the bank column, we record the total amount received in the bank account, which would be the amount including GST. Then in the training fees column, we record $300, which is the amount excluding GST. So this is just the fees revenue to the business, and GST needs to be excluded from this column because it is separately recognized and recorded in the GST column. Next, we record $30 of GST received in the GST column. This is a GST on sale, and therefore it is a payable amount to the ATO. Just as a reminder, we calculate the GST by taking 10% multiply by the training fees amount, which was $300, and this gives us a GST amount of $30. Here's another example of a cash receipt. On the 5th of April, the owner contributed $5,000 to the business. We record this transaction in the cash receipts journal. We start with the date, followed by the transaction details, which in this case is capital. Then we write the source document reference number. And in the bank column, we record the amount that was received in the bank. In this case, it is $5,000. We also then classify the $5,000 received in the sundries column. The reason why capital contribution is recorded in the sundries column is because it is not a very frequent transaction, unlike training fees. Assuming no other cash was received in April, we now total the amounts in the cash receipts journal. In the bank column, we have a total of $5,330. This represents the total cash received in the bank for the month. Out of this amount, $300 was received for training fees. Another $5,000 was received from capital contribution. And the last $30 was GST received as part of the training fees paid by the customer. Now we're going to look at the effects of transactions on the accounting equation. From the transaction on the 1st of April, we have received $300 plus GST for personal training services. This leads to an increase in the owner's equity by $300 because of the training fees, which is a revenue to the business. When revenue goes up, profit goes up, and this leads to an increase in owner's equity. The liabilities have also increased by $30 because there was a GST payable to the ATO due to the GST on the sale. The assets also increased because our bank has increased by $330 as a result of this cash receipt. Now moving on to the transaction on the 5th of April, the owner has contributed $5,000 to the business. Therefore, there was an increase in the bank account by $5,000, which is an increase to assets. And owner's equity has also increased by $5,000 because of the capital contribution. Next, we'll be looking at cash payments journal, where we'll be recording cash payments. This is an example of a cash payments journal, which is pretty similar to the cash receipts journal that we've been working through. Here we have the dates, followed by transaction details, and here we record the document ID, which is going to be things like checks, memos, EFT receipts, and ATM documents. In the bank column, we record the total amount paid out of the bank account. Then we specifically classify the cash payments. For cash payments that are more frequent, such as drawings, wages, and supplies, they will have their own individual columns to record these transactions. For transactions that are not as common, we record them in the sundries column. The GST column is to record any GST amounts that are part of a transaction. Here's an example of a cash payment. On the 2nd of April, the business has paid $1,100 including GST for April rent. We record this transaction in the cash payments journal. First, we write the date, followed by the transaction details and the document ID. In the bank column, we record $1,100, which was the total amount paid out of the bank account. Then we classify the rent payment by writing $1,000 in the sundries column. Firstly, note that we are recording $1,000 in the sundries column, which is the amount excluding GST. Also, note that we record rent in the sundries column because rent is not a very common cash payment that occurs in the month. Then we record the GST amount, which is $100. Note that this is a GST on purchase, which is a refundable amount from the ATO, and we calculate this GST by taking the $1,100, which was including GST, divided by 11 to give us the GST amount of $100. Here's another example of a cash payment. On the 10th of April, the business has paid $1,870 including GST for training equipment. In the cash payments journal, we record the date, the details, and the document ID. In the bank column, we record the total amount paid, which was $1,870. Then we write the cost of the training equipment in the sundries column, which was $1,700, excluding GST. The GST of $170 is recorded in the GST column, and it is calculated as follows. It is a GST on purchase, and therefore it is a refundable amount from the ATO. We calculate the GST by taking the $1,870, which was the amount including GST, divided by 11 to give us $170 GST. Here's another cash payment for you. On the 14th of April, the business has paid $250 to the employee for April wages. In the cash payments journal, we record the date, followed by the details and the document ID. In the bank column, we record $250 that is paid out of the bank account. Because wages is quite a common cash payment that occurs in a month, it therefore has its own column in the cash payments journal. This is where we record the $250 wages paid. Note that there was no GST amount for wages and therefore nothing is recorded in the GST column. Here's another different example of a cash payment. On the 21st of April, the owner has withdrawn $100 cash to buy a birthday present for herself. In the cash payments journal, we record the date, followed by the details, which is drawings, and the document ID. In the bank column, we record the $100 that has been withdrawn. Because drawings could be quite a common transaction that occurs for a business, we therefore have a separate column to record drawings, and this is where we write our $100. Assuming no other cash was paid in April, we now total the amounts in the cash payments journal. In the bank column, we have a total of $3,320, which was the total amount paid out of the bank account in April. This is made up of $250 cash paid for wages, $100 of cash drawings, $2,700 of sundry payments, which can be further broken down into $1,000 for rent expense and $1,700 for training equipment. And we also have $270 of GST paid, which was part of the rent expense and the training equipment. Now we're going to identify the effects of transactions on the accounting equation. On the 2nd of April, the business has paid $1,100 including GST for April rent. The assets go down by $1,100 because of the decrease in bank. The owner's equity also decreases by $1,000 because of the rent expense. When expense goes up, profits go down, and this leads to a decrease in owner's equity. We also recognize a decrease in liabilities by $100 because of the decrease in GST payable to ATO. GST on purchase, which in this case was red, is GST refundable from ATO. Therefore, this reduces the GST liability to the ATO. Now the next transaction on the 10th of April was a payment of $1,870 including GST for training equipment. The assets go down by $1,870 because of the decrease in bank account, which is a current asset. However, the assets also increase by $1,700 because of the purchase of equipment, which is a non-current asset. We also recognize a decrease in liabilities by $170 because there was a decrease in GST payable to the ATO. Same as above, this is a GST on a purchase, which is a refundable amount from the ATO. Therefore, this reduces the GST liability to the ATO. On the 14th of April, the business has paid $250 to an employee for April wages. This leads to a decrease in assets by $250 because of the decrease in bank account. The owner's equity also decreases by $250 because of the wages expense. When expense goes up, profits go down and owner's equity goes down. Because there is no GST attached to wages, we therefore do not have any effects on the liabilities. Moving on to the next transaction on the 21st of April, the owner has withdrawn $100 cash to buy a birthday present for herself. This leads to a decrease in assets by $100 because of the decrease in bank account. The owner's equity also decreases by $100 because of the drawings. Note that when drawings go up, the owner's equity goes down. In this next section, we'll be looking at calculating the cash movements, which basically changes the bank balances. Every day, a business receives cash and pays cash. A cash surplus is when there are more cash receipts than payments. This increases the bank balance. A cash deficit is when there are more cash payments than cash receipts. This decreases the bank balance. By looking at the cash receipts journal and cash payments journal that we have completed, we can work out if there was a cash surplus or a cash deficit. Our cash receipts journal shows that we have $5,330 cash received, whereas in our cash payments journal, we had $3,320 cash paid. This means that we had more cash receipts than cash payments. This is a cash surplus, and therefore it will increase the bank balance. Let's say the bank balance at the start of April was $1,400. The total cash receipts was $5,330, and the total cash payments was $3,320. Therefore, we have a cash surplus of $2,010. Because cash surplus will increase the bank balance, we can therefore expect that the closing bank balance at the end of April would be higher than what we had at the start. After adding the cash surplus to the opening balance, we can work out that our closing balance is $3,410 at the end of April. Here's a summary of what we've learned today. In summary, we record cash receipts in a cash receipts journal, and we record cash payments in a cash payments journal. When cash receipts are more than cash payments, we have a cash surplus. And when we have more cash payments than cash receipts, we have a cash deficit.